Hello and welcome to Business Today Television. I'm Siddharth Zarabi and you're watching easynomics. India's inflation as measured by the Consumer Price Index has fallen to a 18-month low, and that's very clearly good news. In the recent past, we have seen inflation moderate, and now the April CPI data number at 4.7%. And to discuss that sharp dip over the previous month and the longer trend that we have been seeing in terms of a decline, I'm joined by Saugata Bhattacharya, Senior VP and Chief Economist at Axis Bank. Just to recap some of the key points before I come to you, Saugata. April CPI cereals and product index is down 0.3%. The food price index was up 0.6%. The combined index up 0.5%. Urban inflation at 4.85% versus 5.89% over the previous month. And rural inflation has come in at 4.68% versus 5.51%. April CPI food price inflation at 3.84% versus 4.79%. I'm going to pause here and ask for your first thoughts on the latest numbers, Saugata.
So thank you, Siddharth, for having me on your show. Number one, this is better than what we had expected. We were expecting about a 4.8%. This is even lower, and it's coming lower because of the food price inflation, which you just mentioned, 3.8%. So that's good news. There is a risk because we do not know yet how the rains are likely to play out. So that remains a risk. I'm still waiting for the core inflation number, which we were expecting to be around about 4.9 to 5.1%. I'm just waiting for that number, but that is remaining a little sticky. So that's the worry. But having said this, with a start to the year of a 4.7% headline print, that should actually, if things don't go out of hand, if commodities prices, metals prices, energy prices remain more or less moderate that we are seeing now, we can easily expect inflation to be lower than even the 5.1% average that we were expecting before this print. This gives the Reserve Bank a lot of room and leeway in their further monetary policy actions, which I'll come to later.
I'm glad you took the discussion straight away to that point, because the CPI is now well within the tolerance range for the second consecutive month. And you spoke about commodity prices. We've also seen food, which is obviously a significant point. What does this really mean for the RBI mandarins and the MPC members?
So number one, the pause that we had even earlier, the pause in the April policy, which we had expected them to continue, is now much more a certainty. We were talking about likelihood. So, it's absolutely certain that for the June months at least, they're likely to pause. Even otherwise, if, God forbid, there is some problem with the rains, El Nino sets in very harshly, very strong El Nino, etc., rains are patchy, food prices begin to go up, even then, I think they're not likely to jump into a renewed rate hike cycle, because I think both the RBI and the government together jointly will coordinate to find other non-monetary policy measures. Because remember, rate hikes are a very blunt tool and actually affect the industrial, SMEs, other spaces much more than it does food prices. So food prices need to be tackled in case, I'm saying in case there is a problem with food prices going up. In case that happens, trade policy, fiscal policy, industrial policy, etc., all of those will need to be tweaked to address that particular problem. So my expectation is, and remember too, that on the global front, we do expect the Federal Reserve to pause, which is our main counterpart central bank, G10 central bank, global central bank. They are expected to pause in their June policy. So overall, the conditions are good now for the RBI to get into an extended pause, and particularly if inflation, even if it goes up a little bit from the food side, if it remains at 5.1, 5.2, I see no reason for a renewed rate hike. at this point in time. So in terms of monetary policy, we are in for an extended pause. Now we need to see at what point in time they change their stance, because that will become very important for policy, because that will have implications for liquidity management, which is likely to be the bigger problem going into FY24.
Shogoto, how long is this extended pause likely, the one that you mentioned?
So definitely, I mean, if things don't go wrong, I mean, if something happens to oil prices shoot up again, etc. The base conditions are that the policy will extend for the rest of FY24. In fact, there is a chance that in quarter four of FY24, which is the February policy of 2024, there is a chance of a rate cut, a 25 basis point rate cut. Because the reason that I say this is that with growth conditions being now being seen to be moderating, the momentum is moderating. I mean, we are definitely not seeing anything like close to a sharp slowdown, but the momentum is moderating. Interest rates have still not been passed on fully to borrowers. There still remains some passing of the transmission of rates into lending rates. So that will slow credit demand even more. So given all of these, and given by the RBI's analytics in terms of real interest rate, which is the repo rate minus inflation, that probably now has become too high at about 150 basis point, 1.5 percentage points. That, to my mind, is too high. And so there is a possibility, if inflation does progress along the track that we now think, that is our base case now, that there might actually be a rate cut in Q4 of FY24.
Okay, a rate cut in the fourth quarter, uh, the, and if rate cuts were to happen in India, what would it really translate in terms of economic momentum, Shogoto?
So economic momentum still remains, as I said, strong. It's moderating. You've seen your readers, viewers will have seen the PMI numbers, the Purchasing Managers Index, very strong services PMI, quite strong manufacturing PMI, GST collections suggest a very robust economic activity. So all of that still suggests that we have become very resilient in the face of a slowing manufacturing exports, merchandise exports, in the face of very sharp rate increases, with deposits being a problem. So given all of that, we still seem to be very, very resilient. However, the very fact that if you signal a rate cut, uh, financial markets begin to signal a rise. So, I mean, yields will fall, bond yields will fall, equity markets will begin to go up. That will be a good signal for foreign investment to start coming in. The rupee actually might begin to appreciate, and that helps the RBI, and not just from a reserves perspective, so an opportunity for RBI to replenish its reserves, but also as a partial counter to the rate cut, or a stable repo rate, because a appreciating rupee actually tightens condition, because for an export perspective, it tightens financial condition. So, I mean, if things go according to the base scenario that we are now looking at, it does seem that the government and the RBI will have much more policy flexibility in trying to boost growth than they had even, say, a couple of months back.
Okay. Shogoto, there were fears earlier about inflation turning sticky in parts. The question I have for you is, what does this fall tell you about the utility of monetary tightening? Because much of this inflation, frankly, has happened due to non-monetary factors, commodity prices, food prices, the lack of weather shocks, which usually cause seasonal variations. What does this really tell us about the nature of the instrument that has been deployed through rate hikes?
Well, I mean, to a certain, you're absolutely right. So that I mean, a large part of the high inflation, persisting high inflation, particularly core inflation, has been due to supply shocks in various forms: commodity shocks, agricultural shocks, whatever. So supply shocks, which the RBI acknowledges. But the problem, to my mind, is that this can be okay for 6 months, for 9 months, but not for 3 years running. Yeah, so that tends to suggest to me that there is actually a fairly strong demand component. You know, both of us have been talking about this for a long time around, and this relates to the K-shaped nature of the recovery. What I'm trying to say is, in one segment of the households of income earners, the income growth is very strong, which you have also seen with the set of results. The preliminary set of 500 companies for Q4, non-oil, non-petro companies that we have seen, suggests that wage growth has been quite strong, upwards of 11%, down from the 15-16% in Q3, but still very strong. So that's just that disposable incomes and actual consumption power, consuming capability in at least a part of the income classes is very strong. But I mean, I agree with you that in a situation where supply shocks play a large role, monetary policy will not be very effective in bringing it down quickly, and which is exactly what you have seen. So, I mean, even now, core inflation refuses to come down below 5%. I mean, I'm sure you'll see the core inflation between 5.1 and 5.3% even for the month of April. That's, to my mind, is a worry. I don't know what kind of thing the government needs to do. But other than the attempt to tighten, and remember, the other problem in this is a part of monetary policy is also meant to defend the rupee. If you do not raise policy rates in tandem with what the other global central banks are doing, that puts an enormous pressure on the rupee. Even now, the difference between the Indian repo rate and the Fed funds rate used to be about 4.5%. Now it's barely 1.25%. That's the problem with the rupee. And you cannot afford to let the rupee find its own level, because that will create its own set of problems. So the rate increase is not just from an inflationary perspective. There are also multiple ancillary objectives for the central bank. So, I mean, I don't want to sound too technical on this. So, but now at this point in time, I do believe, I completely concur with you, that this is the reason that I'm saying that the monetary policy is now prepared for a pause. But other policy measures, fiscal policy tools, industrial tools, export measures, etc., will now begin to step up and take on the growth initiative that monetary policy probably has come down in the course of this rate cycle.
All those who track this subject know that inflation has not been a problem only for India. In fact, we've seen an unprecedented phase of inflation, very high prices all across the world, including developed economies which had never seen this for practically decades. With the latest data that's come in from the United States, I wonder if you've been tracking that market and other markets, and your sense about whether the worst of the post-Ukraine inflation spike in the developed world, whether that's sort of plateaued, or do you see signs of it petering off given the aggressive tightening in those economies?
So again, you won't be able to talk in general terms. In the US, there are absolutely clear signs that inflation has not only peaked, but it's coming off fairly rapidly. The last CPI print, for instance, 4.5% YOY, definitely shows that inflation is on its way down. And this has been led by energy prices, to an extent, food prices, etc. But even they have the exact same problem that India faces. Their non-food, non-fuel core inflation still remains very sticky as of this point in time. But for the US, the Fed's preferred measure of inflation, the personal consumption expenditure survey-based inflation, that is now down below 4%, close to 3.5%, and is likely to be very, very close to the target rate of 2%. Europe is in a different problem. I believe that European inflation, the Euro area, Eurozone inflation, is more supply shock driven, is more energy driven. So they will probably take some more time to reduce their inflation rates to the target 2%. And as a consequence, the ECB will probably need to raise rates more by at least another 25 to 50 basis points. Inflation remains a huge problem in the UK. So, I mean, across the various developed market geographies, the cause and the trajectory of inflation differ. But without doubt, in each geography, inflation has peaked. And in some geographies, it's coming down within the next 12 months or 18 months is likely to come within striking distance of the 2% respective targets.
Do you expect global financial conditions to ease anytime soon?
Well, you have to make a difference, Siddharth. Global financial conditions have eased significantly already. Bond yields in the US have come off so rapidly now. So 3% odd something from something which used to be 4.5% at some point in time. Equity markets are still, other than the banking problem, equity markets are still are going up. I mean, it's not coming off in the sense that they had come off. Commodities prices are much, much lower. So financial conditions in general in most of the developed markets are actually easing, have actually eased. But credit conditions, particularly in the US, which is the lending rates, which is the credit underwriting, which is the amount of loans that are being given, particularly by these smaller regional banks and community banks, those have tightened significantly. And that is one of the things that I failed to say in the previous round, that signs in the Europe definitely point to a slowdown in economic momentum. Credit has become a big problem for the commercial real estate, which is a very regional based thing for small businesses, for MSMEs, and they're likely to tighten even further because I do believe that there is more stress that is likely to come out of the US banking system. So, given all of this, I think conditions are now ripe for excess demand, aggregate demand to slow down, the momentum to slow down, and as a consequence, inflation, particularly core inflation now, which has been the bigger problem, core inflation will also now begin to come down. Just like, I mean, it's almost a pattern, just like you see in India.
My final question for today to you, how keenly should we looking up at the sky as the clouds start forming from an inflation tracking perspective?
We should be, because I mean this is a problem not just, I mean, in the immediate future. So heat conditions. I saw a study from Harvard University, I believe, if I remember correctly, that the number of days, and of course, I mean, the sky for this year is very, very important from a food and food inflation perspective. But over a period of time, the number of days with temperatures greater than 35 degrees is around 5 in a year, or used to be very, very in the recent past. That is forecast to go up to about 75 by 2021, at the start of the next decade. Mortality rates are likely to go up significantly. I mean, where somebody who works outside in a field, their average mortality will come down by 10 and a half to 11 years. So I think this is something that we need to track very, very closely, not just for this year and the next year, because things are only going to get worse from now, which you are seeing. I mean, which you are seeing in Europe, the rains or the lack of rains in Europe, in the US, etc., water drying up. So that's something, to my mind, which is very, very important. The effect of climate change on agriculture, on rainfall patterns, etc., is something that worries me a lot.
That's absolutely true, Saugata, but for now, at least in the near term, the headline should cause us less worry. April prices, viewers, have fallen to a 18-month low, and the headline from what Saugata Bhattacharya has just told us is that there could be a possibility, ceteris paribus, if all things remain the same, of a rate cut also in the last quarter of the current financial year, which is January, February, March, and I certainly would hope for that. Saugata, as always, a pleasure talking to you, and thank you very much for your time with us today. Viewers, it's a wrap on this analysis of the April CPI numbers. We'll be back with more. Do stay tuned in, and while you do that, do like, share and subscribe to Business Today Television. I'll see you again. Till then, goodbye.